morning, folks. Thank you for joining our webinar series today. My name is Tyson Mavar, one of the ConocoPhillips focused retirement advisors for the retirement group here in Texas. Today's webinar, we're going to focus on some of the biggest mistakes that we've seen some of our clients and many people that we've talked to and worked with over the years from ConocoPhillips make as they transition from active employment into retirement, specifically from a tax perspective. Many of you know, many of the retirement rules and regulations are a bit more complex than some of the typical tax code issues that we navigate on a year-by-year basis while we're working. So we're going to talk about some of these rules and regulations and hopefully add some insight from our experience working with people retiring from ConocoPhillips that can hopefully help you keep more of your money into retirement to have a more successful retirement. Those of you who aren't as familiar with our company, the Retirement Group is an independent financial planning organization. We work with corporate employees throughout the country in an effort to help them maximize what they walk away from their company with, and ultimately maximize their retirement paychecks. We manage retirement assets at the Retirement Group. We do that through Charles Schwab as a custodian, and we are not in any way affiliated with ConocoPhillips, nor are we affiliated with Fidelity, as it turns out. We just happen to have retired many people from ConocoPhillips over the course of the last close to 30 years that we've been in business helping people with their retirement accounts and their retirement transition decisions. We have a whole host of complimentary services. I'll mention some of them on today's call. The one that you should probably take advantage of if you haven't yet is our cash flow analysis. It's a complimentary service. It's aimed at helping people figure out when's the best time to retire to maximize what they walk away from the company with, as well as minimizing their taxes owed, but also some other questions that you may have, such as when's the best time to take Social Security? What's the best option on the pension? Should you consider the annuity option or might it be the lump sum? Should you pay debt off at retirement or maybe before retirement? Many of these questions that our clients and people that we've worked with over the years have had can be answered by a cash flow analysis, running the numbers, projecting it out, giving some conservative assumptions on growth and inflation and taxes to start to identify what decisions will allow your money to last as long as it needs to, which is, of course, is the rest of your life. If you'd like to meet with us, whether on a web meeting, phone call, or even in person, we're in the buildings from time to time. Feel free to schedule an appointment. And I encourage everybody to follow us on LinkedIn, where we produce most of our content related to not only the ConocoPhillips retirement strategies, but also some of the tax code changes, interest rate changes, and where we also talk about our investment philosophy, which is value investing strategy. So follow us on LinkedIn if you have an account. If you don't have one, they're pretty easy to create, and this QR code will get you to our LinkedIn page. So today we're going to talk a lot about the recent changes that have happened to the tax code that affect retirees, some proposed changes that could be coming down the pipeline that will have a pretty significant impact on some people that we work with, and also some different retirement distribution strategies that not everybody that we talk to have really considered and we think are important. Whether or not you do any business with us in the future, should consider as you transition into recreating your paycheck once you leave the paycheck from ConocoPhillips. Now, one thing that has changed in the last couple of years through what was called the Secure Act, which was signed toward the end of 2019 and affected folks who have to take money out of their retirement account. So that's anybody with a traditional IRA, pension plan, and or 401k plans. These assets start to be forced distributions on as you get older. And it used to be age 70 and a half that we'd have to take money out of these accounts. Secure Act changed that age to 72. So the year you turn 72, you will either have to take money out by the end of that year or by April 1st of the following year. And there's some considerations for both strategies, taking it out by the end of the year that you turn 72 or by April of the following year, depending on your projected income in both of those years. But this was a benefit of the Secure Act that allowed us to defer income and therefore defer taxes a little bit longer on our qualified retirement accounts, such as IRAs, 401ks, and pensions. Now, unfortunately, one of the detriments of the Secure Act was that it changed the rules on how non-spouse beneficiaries, typically our kids, maybe our grandchildren, maybe other people that are important to us to receive our assets if we don't spend all our money in retirement. It accelerated the time frame in which they have to take the money out of this inherited account and therefore pay the taxes on this account. Used to be that non-spouse beneficiaries could stretch IRA withdrawals from inherited accounts over the course of the rest of their life, called that a stretch IRA. Now that time frame has been accelerated to a 10-year period. So whereas it used to be that if you inherited an account prior to Secure Act, prior to 2020, you'd have to take out a little bit of money each year for the rest of your life or until that account had been completely diminished. Now the rule states that non-spouse beneficiaries have to take all of the money out within 10 years, but they do not specify how much or what years you have to take money out in. You just have to have drained the account by 10 years. So oftentimes the best way to do this to be most tax efficient is to do equal distributions across that 10-year period. If you see a low tax year coming up, a low income year, you might want to take more money out in that year and less money in other years. Or if you can identify a high income tax year, that would probably not be a great year to take a large amount or maybe even any money from that inherited IRA. But the rules stayed the same for spousal beneficiaries. So if you inherit a retirement account from your husband or wife, from your spouse, that money you could put into your own retirement account, which in many cases will give you more flexibility on how you take the money out and how quickly you have to pay the taxes on that account. Something we'd also talk to you about and have some ideas on when we do your cash flow analysis. There used to be age restrictions on contributing to a traditional IRA. The new rule states that as long as you have earned income, that's the caveat, you have to have earned income to contribute to traditional IRA and a Roth IRA, as it turns out. But you can do it past the age of 70 and a half, whereas you used to not be able to contribute to and take income deductions on contributions to a traditional IRA after the age of 70 and a half. So this was another benefit. Not everybody's still working past 70 and a half, so it might not affect you. But if you are, this is maybe a way to manage your tax bracket a little bit better later in life. And they've also updated the tax brackets. We're going to zoom in here for the income tax brackets. And then toward the bottom, we have the capital gains tax brackets for the different categories that you might fall in. Let's start with the income tax brackets. So you can see the actual tax brackets have not changed, 10% all the way up to 37%. However, the thresholds have changed. They've actually gone up a little bit. And this means you can make a little bit more money and stay in the same tax bracket. This is important for retirement distribution strategies when we're trying to manage our lifetime tax bill and be efficient with our tax brackets over time. This will make sense a little more when we get into the distribution strategies in a bit, but it's just important to say if you're married filing a joint return, you probably want to keep your adjusted gross income below $340,000 to avoid jumping into that 32% tax bracket. If you can avoid it, everybody's different. Some people can stay in the 22% tax bracket, maybe even 12% tax bracket in certain years. But just being mindful of these thresholds and these brackets we find to be important in getting to keep as much of our money in retirement as possible. Then we have capital gains tax rate. A few years ago, they added a 20% capital gains tax bracket for income earners, which is now about $460,000 if you go over that as a single individual, or $258,000 and change as a married filing jointly couple. And this is also important. There could be a possibility you could have zero capital gains taxes if you have a very low income year in retirement, usually. But if you have a certain amount of income that goes over the threshold, you're going to pay some capital gains on some of the gains you might have enjoyed on some of the non-qualified assets. Maybe you have some ConocoPhillips stock as a result of an NUA transaction, a net unrealized appreciation strategy you might have employed with your advisor when you left the company, especially on your Phillips 66 and ConocoPhillips leverage stock that you have in the plan. Some great tax savings opportunities. And you definitely want to make sure that you're paying the least capital gains rate possible. Might affect the year that you decide to sell those shares in retirement. This is a good illustration. We have in retirement, fast forward here, different states that you retire in and how they tax you. The white states are states that have no income tax, no state income tax to add to your federal income tax. The dark blue states, on the other hand, are states that have a income tax that is potentially higher than 8%, depending on your income. And so, moral of the story, this probably you want to build into your retirement plan. If you definitely plan to move to a state with an income tax, make sure you're planning for those taxes, which is going to reduce the amount you can spend, of course. Or it might also change where you decide to move. I have here in Texas many clients that stay here, in part because family's here, in part because of the favorable tax environment. Have clients that move closer to their children and sometimes grandchildren, which could increase the taxes they have to pay in retirement. And just yesterday, I did a comparison, a client that's moving from Colorado somewhere with a lower cost of living and or lower taxes, and they wanted to compare Tennessee to South Carolina, when we found that their money was going to last 2 years longer just from the difference in the state income tax projected over the next 30 years. So it could be something that you would want to make a consideration on prior to making decisions on when you're going to retire, but also where you might live in retirement, because it could mean a big difference to your retirement plan and the sustainability of it. Now, there's some recent changes we're going to talk about, but also some proposed changes that we're watching out for, because some of them could have some major implications on many of our clients with regards to their retirement accounts. So we had some recent legislation, trillions of dollars being spent in the United States as a result of the COVID-19 pandemic. Consolidated Appropriations Act, a multi-trillion-dollar bill signed at the end of 2020, and with spending implications for 2021. Then we had the American Rescue Plan not too long after that, another several trillion-dollar bill. We have some deductions and credit phase-outs that are happening as a result of the tax code changing. There's also some schedule changes to the AMT, alternative minimum tax, coming up. There was some recent changes to retirement plan distribution amounts. This was actually a benefit because they extended life expectancies, whereas required minimum distributions are now lower for our clients. Not too much lower, but a little bit less being forced out of the retirement account, a little bit less taxes as a result. We had the CARES Act provisions expiring, some benefits in 2020 that are no longer the case. And we have changes to long-term care insurance premiums as a result of the more and more people needing some type of assistance, whether it's skilled nursing, assisted living, or some type of help in retirement or later in age, and the cost of such help, or at least to insure against the potential detriment that they'll bring later in life. We also had changes to health savings accounts, rules on how those work, and with flexible spending accounts, which are ways that we could put money away during our career normally, but maybe even in retirement, that are more tax efficient to save for healthcare expenditures. We have some proposed change as well. On top, we have going back to Obama era tax rates, the highest tax rate being 39.6%, but could also change all tax brackets that we saw on the earlier slide. Long-term capital gains rates potentially being taxed as ordinary income. We saw how 15% for the vast majority of us is what we have to pay for selling an asset for more than we bought it for on the appreciation. Whereas if we could be in a 33% tax bracket or higher, which would more than double the capital gains taxes that we pay on appreciated assets. Not a good thing for a lot of people that have money in a non-qualified or non-retirement account that have appreciated, many of our clients being in that category. There's something in the tax code called the step up in cost basis, where if you pass away with an appreciated assets, the beneficiaries on those assets do not pay the capital gains taxes that you enjoyed during your lifetime, just capital gains that they would see after they inherited those assets. That step up in cost basis could be going away through some proposals that are very strongly being promoted in Washington, D.C. right now by some individuals. And we also have a tax that came out during the Obama administration called net investment income tax. It was an additional 3.8% on top of your capital gains taxes of 15% in most cases. If you have income more than $200,000 as a single filer or $250,000 as married joint filers, making it more expensive to sell appreciated assets. But what is potentially changing even further on this is applying this to active pass-through business income. We have some clients that in retirement will open an LLC or start a business of some type. This could affect the taxes that you have to pay on business income in retirement, which would not be a benefit for many people that we help in retirement. They've considered extending the enhanced child tax credit, which was part of this ARPA, the recovery plan. And I've also considered making the ARPA changes permanent going forward. And last but not least, making expanded health insurance premiums tax credits permanent as well. So these could help some people, typically lower to moderate income households, but somebody has to pay for it, of course, and this could be an impact on your taxes going forward. So this is why we stress at the retirement group very, very specifically on your tax efficiency and making sure you're only paying your fair share of taxes and not a penny more when you can understand the tax code as it relates to your retirement assets. So let's talk a little bit about some tax planning for ConocoPhillips employees and some strategies that we talk to many of our clients, not everybody, but many of them on. First, let's talk about the interest rate. So many of you know your lump sum payout when you take the pension as a lump sum for ConocoPhillips, it's based on interest rates. And depending on where you started your career, whether it was Burlington or Conoco or Phillips Petroleum or any number of the different heritage companies, they're going to use these different interest rates differently. If you're Conoco, for instance, you use an additional interest rate called the PBGC rate that's not listed on here, but it's 0.0% currently. Whereas if you're Phillips or Burlington, you're just going to use the what are shown on here is the first, second, and third segment rates. Those are based on corporate bonds, by the way, as well as the 30-year Treasury bond interest rate. And the way the company observes these rates, they're going to look back to the 4th month prior to the quarter you commence your benefit. That's very important. Not the quarter you retire necessarily, but the quarter that you take your pension. Oftentimes that's the same time as you retire, but we recommend many employees actually defer electing their lump sum, whether it's because they have some age penalties we'd like them to age out of, or potentially because we foresee interest rates going down and their lump sum going up if they are willing to wait to take that pension. On the other hand, if interest rates are going up and we predict our lump sum will be going down, oftentimes that's a catalyst to take that pension out and also start earning some interest on it outside of the plan, maybe in an IRA or in the 401k plan. So what are we seeing here in this slide? We have a table of different interest rates, December being published very recently, December of 2021. That will depict what the second quarter 2022 retirees who commence their benefit in the second quarter, what interest rates they'll be using to calculate their lump sum. And we just like to show people these because these interest rates fluctuate and it can mean several $100,000 more or less in your plan, depending on the timing of your election on this. So you can see here in the December interest rates compared to September of last year, which depicted the first quarter lump sum recipients payouts, the interest rates have gone up. So if you're somebody who's already left the payroll but hasn't taken your pension yet, you may want to consider taking the lump sum out prior to the second quarter to avoid losing money. Now, the commencement dates have to be on the first of the month. So you'd have to have a commencement of March 1st to get a first quarter interest rate compared to April, May, or June, which would be in the second quarter, of course. But then we'll go over here to the right. The 30-year Treasury interest rate actually went down a little bit, helping to offset for some the increases to the corporate bond interest rates. Now, how much these rates impact you depends on how long you've been with the company. The longer you've been there, the more relevant the 30-year Treasury interest rate is because they changed that over with the Pension Protection Act, kicked in for pension payouts beyond 2008. But it also depends on your heritage company. So we have to look at these. And this is another reason why we strongly encourage people to not just work with a financial advisor in retirement, work with somebody that has experience working with people in your situation, people that have retired from ConocoPhillips, so they understand the implications of different decisions and the timing of some of these decisions when it comes to taking your money out, paying taxes, and converting that into a paycheck after you've left the company. Now, there's also some tax implications when you create this paycheck after you leave the company. Most people will move that lump sum either directly into their 401k. Maybe it's because they haven't picked an advisor that they want to work with yet. Maybe because there's a lot going on and they haven't had a chance to do their due diligence of how to invest that money. Most people eventually will roll that money into a traditional IRA, which there, of course, is no taxes to do because it's going from one retirement plan into another. And you don't pay taxes until you withdraw money from that IRA. The reason most people will do that is because there's substantially more investment options available in an IRA compared to the 401k that the company sponsors. Now, there's also different costs associated with that. So you need to make sure that you understand the reasons that you're doing some of these things, whether it's to be more efficient with taxes or just to be able to protect and grow your money better. And that's another thing that we talk to people about when we go through their cash flow analysis. Now, it's possible you may have some after-tax money in your 401k, which we call spillover contributions, either because by choice or by force, you put after-tax money in your 401k. There's probably a better, more tax-efficient home for those after-tax assets. If you're still working, this is one way that a lot of our retired clients did a test run of our services at the retirement group before they left the company, was to have us manage some of those after-tax contributions in a Roth IRA, which is an account that grows tax-free versus the after-tax contributions in your 401k that are tax-deferred, and you're going to have to pay taxes on those earnings in the future. So something to consider if you have any after-tax money. Many of our clients make good salaries and as a result are able to contribute more than the tax-advantaged limits, which is $26,000 per year if you're over the age of 50 and get the catch-up contribution. You can actually contribute up to $64,500 per year. The additional amount over and above the tax advantage limit just has to go into this after-tax bucket or the spillover contributions slice of the pie here. But it's more efficient to be in a Roth IRA in almost all cases. So to talk to us or somebody about what your options are with this. And not only might it make sense just to get the feelers out there and see who's a good fit for your business in retirement. If you're considering working with an advisor, there's also some tax reasons you may consider moving some money out of the 401k while you're still working at the company. Now, we're going to talk about some different withdrawal strategies and what accounts to take from and how to do it in retirement. First, we'll talk about the conventional withdrawal order. And I want you to think about your retirement assets as three different buckets. You have your taxable assets, that's like your brokerage account, your bank account, maybe you bought a CD, any interest that's taxable every given tax year, as well as the capital gains that are realized being taxable. Call that a taxable account. Non-qualified is another name for this type of account. Then you have your tax deferred accounts. Most of our clients have the bulk of their retirement savings in these types of accounts. So IRAs, 401ks, your pension, if you take it as a lump sum. You got to defer the taxes on the earnings and interest on those accounts, but you have to pay ordinary income taxes on all of the withdrawals in these accounts. Then you have your tax exempt accounts, which would be your Roth IRAs. Not only are the withdrawals tax-free, the earnings are tax-free. You just pay taxes up front on what money goes into those accounts. So the conventional wisdom here, the conventional withdrawal order was to burn down your taxable assets first and keep your tax exempt or your Roth IRAs last to be able to grow those accounts tax-free for the longest period of time. Unfortunately, it doesn't consider all of the realities of our progressive tax system. We'll give a couple examples to show you why. All right, so in the first example here, we have the conventional wisdom that says spend your taxable money first, then the tax deferred money, and then the tax exempt money. So this person retired at 65. Their first year's income, it looks like they needed $60,000. So they took all of it out of their brokerage account, their non-qualified taxable account. Year two, they didn't have enough money in that account to make it through the year. So they switched over to tax deferred account withdrawals later in the year. Social Security kicked in at 67 for this individual, which means they didn't have to take out as much money from their tax deferred account. And that account had been completely depleted by age 83, it looks like, at which time they started making withdrawals from their Roth IRA until age 95. So total tax paid was about $36,402. Now, granted, this is an example for some people. I have some clients that are spending 3-4 times this in retirement, which is going to make this distribution strategy that much more relevant, 3 or 4 times more relevant in terms of the tax savings. So just keep that in mind. Now let's look at an example of a tax-informed withdrawal strategy, as we call it, the retirement group. So in this case, we're being aware of our tax brackets and being also aware that our tax-deferred accounts are actually the least valuable to us. Why is that? Well, because dollar for dollar, that account or those accounts have the least amount of money that's actually ours because they're fully taxable at some future ordinary income tax rate. So we owe the money to the government, we just don't have to pay it all to them today. Whereas your taxable accounts, you've already paid tax on that with the exception of any unrealized capital gains. The tax exempt accounts are the most valuable accounts to us because that's all our money, that's all tax-free money. So how do we use this strategically to minimize our taxes and maximize how much of our money we get to keep? Well, what we recommend is filling up the lower tax brackets with tax deferred or taxable income. And then in an effort to stay below really high tax brackets, we will supplement our tax deferred income with non-taxable income or income from accounts where we don't have to add to our ordinary income tax bracket. So you can see here, we deferred those Roth IRA withdrawals until the taxable account had been depleted. But what this resulted in was 2 extra years of income because of the less taxes we paid by maintaining a lower tax bracket and by using the flexibility of having multiple retirement accounts to manage our tax bracket over time. So step 1, fill up lower tax brackets with tax deferred income each year. Step 2, be aware of the taxability of Social Security benefits. They're not fully taxable, but they're partially taxable. And strategically utilize taxable and tax exempt or Roth accounts to supplement our income needs. And fortunately, it takes a little bit more work and you have to be a little bit more proactive on this, but we strongly encourage people be proactive and not reactive when it comes to figuring out how to invest your money, when to retire, and also how to fund your retirement or what accounts, and also what investments to pull from as you're paying your bills throughout retirement. Now, we also have some penalties we want to watch out for. Anytime you take money out prior to 59.5 from a qualified retirement account, like an IRA, 401k, even a Roth IRA, there's some potential penalties, a 10% early withdrawal penalty, unless you qualify for one of many exceptions. So let's go through these really quick. We have a potential medical expense exception, a health insurance expense exception. If you're on disability, short-term or long-term disability, you can make exceptions for withdrawals prior to 59.5 and paying the penalty. Inherited IRAs, like we talked about, if you are on the old system of the stretch IRA, or if you're on the new system of the 10-year rule, all of those withdrawals are penalty-free. You just have to take out enough to meet the requirement. Life expectancy, part of the tax code, IRS code 72T, allows for substantially equal periodic payments from a retirement account prior to 59.5 that are penalty-free. You just have to set it up. And unfortunately, in a low interest rate environment like we're in today, the amounts and limits that the IRS imposes on these withdrawals are pretty low, not always useful or appropriate for somebody who needs to recreate their entire paycheck, but in some cases can supplement income from maybe a part-time job or maybe spouse's income. Part of this code is also what's called post-55 distributions. It turns out if you leave your company, leave ConocoPhillips in this case, on or after the year you turn 55, you could take penalty-free distributions from your 401k and or pension. Now you have to observe the ConocoPhillips withdrawal and distribution rules, but this is many of our clients, whether they got reduction in force notice or they've retired voluntarily or just left the company for a part-time job to transition slowly into retirement, but it was before 59.5. This is a great way to supplement your retirement income on a penalty-free basis. You just have to leave some of your money with the company if you develop that strategy. We also have qualified higher education expenses, first-time home purchase, not a big one. It's $10,000, but it might help. Qualified reservist distribution exception, childbirth exception, 415 limits, which are for highly compensated employees, or the IRS doesn't let you roll over all of your pension or all of your 401k, but an exception to the penalty rule nonetheless. And what I mentioned earlier, net unrealized appreciation, a way you could pay capital gains taxes instead of ordinary income taxes on your appreciated shares of company stock, Phillips 66 and ConocoPhillips specifically. Great strategy. Also a way that you can reduce your penalties in retirement by distributing those shares outside of your retirement account framework. We also have flexibility from the ages of 59.5 to 70.5 or 72, depending on when you turn those ages, January 1, 2020 being the cutoff date. You have flexibility, but then once you reach the age of required distribution, then you have to take a certain amount of money out of your accounts and you have to pay taxes on these. This is also a great time to strategize on how we're going to prepare for these required distributions down the road. And in many cases, depending on our clients' objectives, we may encourage Roth conversions during this time frame to get money out of the taxable framework and into the tax-free framework, especially if you're somebody who thinks that tax rates are going to have to go up after the enormous amounts of taxpayer money we spent in the United States in the last 2 years. Could be something to consider now, Roth conversions to pay taxes to avoid higher tax brackets in the future. But then you lose a lot of control once you turn the age of required distribution, 70.5 or 72 now, because you cannot convert RMDs to a Roth IRA. You have to take that money out. Your conversion would be on top of the RMD, somewhat limiting in many cases how much you can convert to a Roth IRA. Folks, it's staggering that 74% of Americans statistically, those that are over the age of 50, do not have a written plan for retirement. Don't be a part of the statistic. There's no excuse for it. I mentioned earlier, we're delighted to run a plan for you, complimentary, free of charge. It helps us to grow our business because it gives us an opportunity to add some value before you retire. Hopefully you put us on the list of potential advisors once you get to retirement. No hard feelings if you don't. Very least, we're very confident that you'll get enough value going through that exercise, that you'll help us grow our business by maybe referring us to a couple coworkers. But take advantage of it. Call us at the home office if you haven't done one yet, or if it's been over a year since we've updated yours. Here's some of the things that many of our clients have told us they're looking for in an advisor and what we strive to meet in terms of our clients' expectations. Understanding the ConocoPhillips benefits plans in and out to not make any mistakes on our way out the door, not leaving any money on the table with the benefits, and never overpaying in taxes by not understanding the rules. Understanding the costs that we charge and many of our peers in the industry charge, and also the value that you're getting for our compensation, making sure it's a good fit. And we're not for everybody, but we'd love an opportunity to tell you our story to see if it might be a good fit among the many choices you have. Make sure that whoever you work with has an experienced team. I am very blessed at the retirement group to be able to have not only an experienced team, but a very deep roster of advisors that helps me to communicate more frequently and efficiently with my clients and not have to worry about doing research day in and day out, but also gives my clients comfort that if something happens to me, whatever it might be, there's a good backup plan, somebody that can step into my shoes and continue to meet their plan needs. Ask yourself what it is that's important to you. Is it purely performance net after the fees? Is it a user-friendly website? Is it assistance with the tax code and retirement rules? Administrative and paperwork assistance, communication we found statistically is the most important attribute. An advisor has two clients, at least that's what clients say. An advisor that has too many clients might not be able to effectively do that. You probably also don't want to be the first client of your advisor either. But figure out what it is that's important to you and talk through that with an advisor, maybe a couple different advisors, to see who the best fit is. And maybe, like I mentioned earlier, do a test run of one or a couple different groups before you retire to truly see if the proof's in the pudding and make sure that's going to be a good fit. And don't pay for a plan. One of my clients from ConocoPhillips, one of the reasons he said that he went with us is because he met with an advisor that charged him $2,000 for a plan that he communicated to me he felt was inferior to the plan that we ran. So take advantage of that, because it's usually pretty expensive for many companies out there. but we produce a lot of these because we work with so many people from ConocoPhillips, making it easier for us to produce. And one of the ways that we grow our business by having the opportunity to add some value to somebody's retirement plan prior to the decision-making time. If you'd like to talk with me or any one of my coworkers at the company who work with ConocoPhillips employees and have a very active interest in the plan information, the QR code here on the left will get you onto our calendar, even if it's just for a 10 or 15 minute conversation. Maybe you want to ask some questions, or if it's going to take a little bit more time to put together the cash flow analysis, we'll be delighted to present that to you on a web meeting in person, or maybe just over the phone to give you some highlights and also help you identify what you should be focusing on now while you're still working, so that you don't focus on the wrong areas and waste a bunch of time focusing on something that's not relevant to you. If you have any specific questions, you can, of course, call us at the home office. Our number is listed here, or you can also email any questions you have to info@theretirementgroup.com, and we'll do our best to get back to you and hopefully answer your questions and add some value so that you can have the most comfortable and successful retirement possible after you leave ConocoPhillips. So with that, we're going to wrap it up for today. I appreciate everybody joining. I know we had a lot to talk about, but if you do have any questions on today's material, or would just like to schedule a call with one of our ConocoPhillips focused advisors, feel free to reach out to us. We're here to help folks, even if you already have an advisor or plan on doing everything on your own. We're delighted to spend a few minutes with you just to make sure that you don't make any of the costly mistakes that so many employees before you have made. Thanks again for joining us today. Everybody have a good, safe rest of your week, and we hope to talk to you all very soon.